All right, let's talk money in your 20s. Today, we're going to break down a pretty counterintuitive financial strategy. And look, we're going to skip all the usual advice you hear everywhere else and get right to the analytical core of how you can build a really strong financial foundation, starting now.
So let's just dive right in. The big question is this: are you actually solving the right financial problem? I mean, we've all heard it a million times, right? Start investing as early as possible. But is that really the best advice for someone just starting out in their 20s? For a lot of people, it's kind of like trying to solve a problem you don't even have yet.
Okay, so this really lays out the core conflict perfectly. On one hand, you've got the common approach: take that $7,000 you saved and put it in the market. Best case, in a great year, maybe you make $700. Not bad. But then look at the analytical approach. You take that same $7,000 and invest it in yourself. Now, the potential return isn't just a small percentage gain. We're talking about a fundamental shift in your earning power, like adding $10,000 or more to your yearly income. The difference is just massive.
And this is where we see a really common financial misdiagnosis. The reason prioritizing market investing so early often doesn't work is because it misses the point. We're told over and over to focus on growing our assets. But that's kind of like trying to build a giant skyscraper on a foundation of sand. It just doesn't work.
This right here, this is the key insight, according to experts. For most people making less than $50,000 per year, you do not have an investing or savings problem. You have an income problem. Think about that. The real bottleneck isn't how well your money is growing. It's that you simply don't have enough income in the first place to generate the kind of capital that makes investing truly meaningful. Nailing this down is the absolute first step to building real wealth.
All right, so let's actually look at the math, because this is where the flaw in that conventional wisdom becomes super clear. We're talking about the real problem here, the income gap.
So let's paint a picture. Let's say this is you. You've just graduated, you landed your first real job, and you're pulling in about $40,000 a year. A pretty typical starting point, right? So, what's your next financial move? Okay, so you're being responsible. After rent, bills, food, life, you managed to scrape together and save $7,000. That is awesome, for real. That's your investment capital for the whole year. But let's be honest, it's a pretty limited resource. And here's the best case scenario outcome. You take that $7,000, you put it in the market, maybe an index fund. And let's say it's a fantastic year for the market. You get a 10% return. Boom, you just made $700. I mean, it's money, it's positive, but what's the real impact here? And that's the real kicker. That $700, it isn't going to meaningfully change your life. It's not a down payment on a house. It's not going to magically fast forward your retirement, and it sure isn't financial freedom. You see, you've played the game exactly as you were told, but the stakes are just too low to make a real difference. So, if that's the problem, what's the solution? Well, it's a two-pronged strategy that completely flips the script. It shifts your focus away from passively trying to grow these small amounts of money to actively generating serious capital. Okay, here's how the mechanism works. It's two simple steps. Step 1, create the capital. This means you get aggressive about lowering your expenses. Live as lean as you can to free up every single dollar. That money is now your investment capital. Then, step 2, and this is the most important part. You invest for a way higher ROI. You deploy that capital not into stocks, but into acquiring valuable skills that directly, measurably increase how much money you earn. This creates this incredible, powerful feedback loop.
So what does this actually look like in the real world? Well, we're talking about things like sales training programs, coding and tech boot camps, courses on social media marketing, heck, even getting a real estate license or other professional certifications. Think about it. A coding boot camp could land you a job with a $20,000 raise. A sales program could teach you to close deals that double your commissions. These are the kinds of high-value skills that the market is willing to pay a serious premium for.
And when you see it visually like this, the contrast is it's undeniable. That same $7,000 that maybe gets you $700 in the market could realistically add $10,000, $20,000, maybe even more to your annual income. At this early stage of your career, the return on investment in yourself absolutely dwarfs anything the market can offer you. It's not even close.
Now, it's super important to understand this isn't a forever strategy, it's a phase. Once you've successfully solved the income problem, your focus has to shift. So let's talk about the pivot to market investing and crucially when that shift should happen.
And this is the target we're aiming for. It's called the pivot point. It's that income threshold somewhere around $70,000 to $100,000 a year where your primary focus can logically shift from investing in yourself to traditional market investing. Why? Because you fixed the core issue. You've solved the income problem. Now you have enough capital coming in to actually start building real wealth through assets. And from there, the path forward becomes really clear. So you hit that pivot point income. That's step one. Then, step two, you start deploying that much larger amount of capital into assets. And finally, step three, you get to accelerate your wealth compounding. This is when the magic of compounding really starts to work for you, but from a much, much stronger financial position.
So now your strategy evolves. You've got a higher income and you're generating significant capital. The big question is no longer, how do I make more money? It's, where's the smartest place to put this money? So let's do a quick high-level overview of your post-pivot options.
Okay, so each of these asset classes has a different job in your portfolio.
You've got index funds, that's your simple set it and forget it broad market growth. Then there's real estate, which is awesome for generating cash flow and getting huge tax reductions, thanks to things like depreciation and leverage. Retirement accounts, your 401ks and IRAs, give you incredible tax-advantaged growth. And then you have something like Bitcoin or crypto, which can be seen as a hedge against inflation or a pure speculation play. But you have to be ready for some serious volatility. A really solid portfolio is probably going to use a mix of these depending on your goals.
But at the end of the day, it all comes back to this one fundamental idea. The absolute core takeaway here is to focus on increasing your value first before you focus on increasing the value of your portfolio. So I'm going to leave you with a final question to really think about. What is the single most valuable skill you can invest in today to double your earning potential? Whatever your answer is to that question, that is your first and by far your most important investment.